All right. So this is the final chapter, wrapping it up. So up to this point, we should have helped you to create a strategy, helped you create a brand, helped you understand your marketing, helped you understand how your marketing and brand and strategy all work into your sales. You should have a process in place and your financials. So we take all of those things and put it into one nice consolidated pitch deck, which I do have templates for. I have templates for both a pitch deck and a business plan, and we'll go over who you talk to with which one because it does matter. So we'll go over that today. But the point of this chapter is to help you understand the debt stacks, what a debt stack is. Oh, you changed the title. I like Virgin Capital or Virgin Stacks. It was weird. But understanding what a debt stack is, how you can utilize it, how you can utilize funds within your strategy, and hopefully not make some of the mistakes that I know Melissa and I have both made. Melissa talks about that a lot. So that's why she's here, is to help provide clarity on both some of the mistakes she's seen and how she can mitigate some of the risks. So diving into it. The battlefield today. So, Melissa, this is just kind of an overview of what the environment looks like. Deals are getting really hard to fund. I was just talking to Melissa about this. The banks, for whatever reason, I can't get anything that's not commercial real estate secured through. I've talked to several people. I don't really have a definitive answer. I assume there's some skepticism in the markets. It's causing a little bit of it. A lot of people have been burned. I know venture capitalists are no longer working the same way that they were 10 years ago. I know a lot of them have moved more towards like a traditional banking type underwriting, where used to it was a lot more not necessarily laid back, but they looked at different things that included the stories and the brands, and they were more apt to fund deals based on the story of the business and making sure that the financials worked, where banking focuses very much on the financials. Although I will say the last 2 or 3 clients that I've worked with, and I think they were all referrals from Melissa, actually, now that I'm thinking about it, they had tried to secure funding in multiple different ways, but they did not tell the story. Just going back and understanding their story really helped get us move forward on a lot of the deals. Um, Going back to the saying that we used in, I can't remember if it was marketing or branding, facts tell, but stories sell. So in your pitch deck, everybody just wants to focus on the pro forma. And I guarantee you, if you polled 9 out of 10 credit analysts, they would tell you it's all about the pro forma. But I've worked in that position. And now on the other side of things, I can tell you the story makes a huge difference. So don't skip over the story. Because it really connects the dots of who you are, why you're doing what you're doing, and how the money works within your business. The pro forma that we created really just proves the stability and the belief that this is real. They're looking, the banks, venture capitalists, whoever we're talking about, we'll go through how they determine different deals here in a little bit. They're all looking towards the numbers to add security and feel more comfortable at it. With the pitch, but ultimately the pro formas are just somebody's best guess, and really until you start operations, they don't mean a damn thing. So the story helps create a level of comfort with the numbers. So if the story's missing, or if you skip over that part, which Lloyd won't watch this, so I'll pick on him for a minute. His pitch deck was all about the numbers, and it was done very well. Going back through it, we met with an investor yesterday, and after we explained to him the story, he's like, "Oh, well, now it all makes sense." So it was the story that was missing in the original pitch deck that we had to go put back. So like I said, this chapter is different in a lot of different ways because this is the only example that we use that the example that we're using is still alive within the still working and operating today. So Richard Branson is probably one of the best examples of how you can use different types of funding in different types of scenarios to build an empire. So when he started, Richard Branson, for those of you who don't know, he is the founder of Virgin. There we go. So Richard Branson is the founder of Virgin, both Virgin Records and Virgin Airlines. He started Virgin Records in his basement, I believe, just shipping records back and forth, just in using snail mail. We don't even know what that is anymore, right? He had no investors. He had no safety net. It was just something that he loved doing, and he started doing it and bootstrapped every single thing that he started with. So bootstrapping we'll go over later, but it's using your own capital to start the business. But then once he started outgrowing the space at his own house, he started taking on small business loans, and he used a small business loan to open up his first record shop. But then the record shop started growing so fast, he used debt to build a distribution channel and started pressing his own records. So just to put this in perspective, using his own capital, then he started using a very small personal loan, then he started using a commercial loan, and then he's continuing to grow Virgin at a rapidly and he decides he's going to bet big, and he used Virgin Records as collateral to launch into Virgin Atlantic, which is Virgin Airlines. He faces a little bit of a crisis. Airlines are impossible to start. I think it was a real rocky start for him. So he sells off Virgin Records to keep his airline alive. So now he's bringing in investors, selling off bits and pieces of his companies to continue the growth of it, and eventually launches an IPO, which brings in the entire stock market worth of investors to help fund the globalized growth of Virgin to what we know of it today as being one of the most successful businesses in the history. So that is a good example of how you utilize debt and a debt stack. And we'll talk more about that coming up. So why is this not moving now? Okay. But some of the big things that we see, we've already talked about telling the story. Most people just want to comprise their pitch decks full of numbers and very fancy, sophisticated algorithms and things like that to showcase that they can support a deal. Ultimately, there's a level of caution that every credit analyst and venture capitalist and investor takes when looking at a pro forma, because the numbers aren't real. You have to look at it with a grain of salt, basically. So if you can't support the numbers that you're talking about and show how you got there, number one, why it's important to your business, and what happens in down times, then no credit analyst or any type of investor is going to take you serious. The other big mistake I see, and Melissa, this was one of the issues with the guys out of North Carolina.
Dwayne and Tabitha.
Dwayne, yep. So Dwayne had fantastic guy, great guy, had a wonderful business, but he made a mistake. He took on a bad business partner, which I've talked to so many very successful entrepreneurs that have done that. So you can't even blame much of that on, I mean, you can't, whatever. But he didn't want to put that into his pitch deck because he didn't want to admit that he made a mistake. And that was the big difference between him not getting funded and getting funded. Was I went back and I put in the story of, okay, this mistake happened. This is a mistake that a lot of really successful entrepreneurs have made. And this is how not only did he mitigate the risk, but also what he's done to come back from it.
Rob, I
have
a quick question about that. If you've partnered with someone and that enterprise became a failure, And do banks look at the other person that was involved when they make a judgment on you?
So if I understand the question correctly, are they going to like is it going to hurt your reputation if the other person has a bad reputation?
Yeah, kind of. Yeah.
It can.
If there's negative news, maybe?
So,
Yeah, if there's especially if it's somebody who I was talking to Lloyd yesterday, and one of his former business partners lost a business because of some sexual harassment.
Mhm.
So they had to shut down the business, and basically they just started the same business under a different name. But with that, I don't.
You
Yes
want to know
and
who
no.
you're working with. I mean, you really want to know before you say yes to a partner. You kind of want to do your own background check on them, because if it's affecting your brand, it's
Right.
going to affect you.
Yeah.
Period. There's no way around that.
There's instances where you can come back from it. Well, yeah, it's going to hurt. And people are always, it's always going to be a stain on your record, right?
Yeah, it was kind of funny this morning. I was talking with someone, and this other venture I'm working with, and I mentioned the word partner. I was driving in my vehicle, but the moment I mentioned partner, I just started coughing, and I couldn't get my words out, and that's because I've had subliminally maybe some bad experiences with a couple of partners, even family members, which really sucks. But he said to me, "You okay?" And I told him the story about bad partners. He said, "Well, maybe that's a sign you need to do this by yourself."
I've had several attorneys tell me a divorce is significantly easier than a,
Yeah.
a business partner split.
Mhm.
Same.
So
It's
either way,
very
don't hide the mistakes. Stuff happens to everybody. In fact, I've only met one entrepreneur in my entire life that said he's never made a mistake, and that guy is a terrible entrepreneur. I don't believe him, number one. And the second he said that he's never made a mistake, I was like, this guy's full of shit. I don't believe a word he says after that.
How are you thinking that? I've got to be full of shit.
Everybody makes mistakes.
Yeah.
I don't know how many deals I've underwritten. I've never seen a perfect deal. I've never seen a deal that didn't have what we call in the business didn't have some sort of hair on it.
Mm-hmm.
Pitch a vision that doesn't match a model. So a lot of people here's what I think happens, and building my own pitch decks. This is what I've done before. Is you start building it out, and then things rapidly change, right? So you start building your brand, and then you start doing market research, and then you have to change something, right?
Mm-hmm.
Well, you forget to go back to the beginning and update all of it to make sure it all flows together. So it's not even necessarily that somebody's lied or anything like that. It's that they just didn't cross all the T's and dot all the I's and make sure that the story stayed continuous. So make sure that what you're saying in your pitch deck actually lines up with the numbers. So I think I talked about this in the pro forma. If I'm trying to understand how all of a sudden, and actually we talked about this on the meeting with Lloyd yesterday, because he was like doubling every 2 or 3 months. And the investor that we were talking to was like, you can't grow that fast. And then after we lined up all of the deals that he's actually got LOIs and contracts on, we're like, actually, he can grow that fast. So, and I polled a bunch of bankers before I wrote this chapter about pro formas, and they said they're all bullshit. They don't line up, they don't match. So, it is very important that if you say you're going to be able to sell X amount, that you can support it in your marketing and sales pieces of your pitch deck. Another mistake: show potential but no path to profit. We see this all the time. I don't know how many people I talk to that say, "Oh yeah, I make $1 million a year," but after you break down their P&L, they're spending 1.5 million to make $1 million. So they're actually losing money at the end of it. So you have to be able to show how. So we'll get into this a little bit later, but venture capitalists in particular, they want to know how fast they can get their money back. Banks want to know how consistent you can be by paying them back. So you have to be able to show those metrics of how they're going to get repaid to get funding. Treat funding like an approval instead of a partnership. I have run into this where you bring somebody into your business, and it's an external partner, and that can be a landlord, it can be a funding partner, it can be a fractional CFO, and they don't meet your brand requirements. And even though it's somebody who is not technically in the business, they still have an impact on the business. So you still want to make sure that all of those things line up with your brand as well. So if your CPA or your bank or your venture capitalist don't align with your brand, then you're always going to be in conflict. And so you want to make sure whoever you do business with aligns with everything. And then they build fragile plans. And this is what Melissa here is here to talk about, where they build plans that if they fail, they lose everything. And that is awful businesses you can lose your family, you can lose your house, you can lose all of your money. So it's not just how much you're putting up for collateral. It can be your entire life if you're not careful. So you want to have steps in place to mitigate the risks, and don't ever bet more than you can lose. All right, so the strategic cheat code, this is what we can learn from the Richard Branson story. Know your stage of growth that you're in. So we talked about how Richard Branson started very small and continued through different cycles of fundraising to grow it into the Virgin Empire. He knew from the beginning that he had a good idea, but he didn't put more money into starting this idea than he could afford to lose, and he put his own personal funds in. Then as he started to grow, he recognized his growth patterns, and then he could take on more risk. So he started with banks, because banks are perceivably less risky than a venture capitalist firm. Then he expanded into investors and venture capitalism, and then he expanded into the capital markets or the stock exchange and things like that. So had he wanted to start off with a huge print of Virgin and immediately launched an IPO, who knows where it would be. But there's a scenario in there where he fails and loses everything, and we never know who Richard Branson is. Weigh the goals versus your risk. Every funding option trades control for speed or security. So each one of these, we're going to go through several different types of funding. All of them have pros and cons. Banks, for example, are very slow, or venture capitalists are very quick. Angel investors, I say, are probably the quickest. I got myself there. But there's a trade-off, right? So banks are slow, but that's the cheapest option you have, because they're not going to take equity. Angel investors are very quick, but they're going to take every cent of equity they can get. And if you have a flourishing business, that's going to end up costing you a lot in the long run. So there's pros and cons to all of it, and it's up to you to understand what the tools are and how to utilize them to the stage that you're in. So learn the tools, and that's what we're here to do today. Learn what the difference between bootstrapping, debt, equity, and some of the specialized funding sources are, and then study the players. So Bronson and others proved the right funding can open doors and not close them. Basically, what it's saying is he understood how to conservatively, if you can even use that word for Richard Branson, raise debt in a way that he can always keep up with the pace. So the tactical takeaways, how do we make this operational for you? Funding. The funding path starts with knowing your stage and goals. So I do have a quiz set up. Eventually, I'll have a workbook. Right now, I have the quiz done, which we will send out with the notes. You can, if you don't understand what level of growth you're in, then you can take the quiz that can help you identify it and then match you with certain ones, so you don't have much. What was that?
I was just coughing. Sorry.
So you don't have to go through and try to study every single one of these. You can listen to the videos and determine which one's right for you, or you can take the quiz and just focus on those ones. The answers will help you reveal the lane of the maze. So funding is a huge maze. There's so many tricks and turns and things that it can really turn a lot of people off real quick. And each one of them have their own processes and procedures, and it's really annoying. So that we're here to help you get through the maze of it. And then once you know your lane, you can use the glossary, which will be provided in the book. Like I said, you can flip to whichever funding source you want to research, or you can read all of them, whichever. Go ahead.
There's another cough.
What was that?
There was somebody else coughing. It wasn't me then.
Oh, okay. So just to put this in perspective, evaluate your current financial position, what you have to offer as collateral, what types of payback you have, then determine your growth goals. There are some of them will allow you to grow quicker, where something like banking is going to be a lot slower. So how fast do you need to grow to hit your goals, and which one of the avenues can help you reach those goals? And then analyze the market conditions and industry. The banks are going to do this, and if you do it for them, then you head off them making a wrong assumption. So we do talk about strategy, which we do some of the market analysis already. But the more educated you are on the market conditions and what's a good example is the deal I'm working with another guy. I created the pitch deck as a banking credit analyst. And there was a way that the revenue should have been calculated that because I'm not an expert in that industry, I didn't know. And so I sent it to a friend of mine who luckily he's a friend of mine, and he came back to me and said, no, this is the way it needs to be presented before he sent it off to some investors. But had I just sent those off to investors that I didn't know, they would have just looked at it and determined that we didn't know what the hell we were talking about and just said no. So there's specific words in the industry, and this is where it gets real tricky, is if you're working with a funding partner that has a lot of experience in the industry, you need to use specific industry language. But if you're sending it to somebody like a bank, where it's going to go to somebody who's a generalist, like a credit analyst, if you use too much of that language, then they're not going to know what you're talking about, and you're going to go way over their head. So it's kind of a balancing act and understanding who you're sending the pitch deck to and updating the pitch deck to fit who you're sending it to. And then last, make sure you can.
Honestly, it ties back into knowing who your customer is, right? Like if you know who you're pitching, like you know what language you need to use.
Mm-hmm.
Also,
that's a good point.
lender is because different lenders specialize in different types of lending. Starting businesses up to 5 million is totally different from 5 to 20 million. Is totally different from 20 million plus.
Yep, exactly. And a lot of this information, to your point, Mindy, can be used in multiple different scenarios. Like the know who you're pitching can be used not only for pitching your potential customers, but also your banks, your partners, and everybody else that you're going to have to bring on. What is that noise?
Somebody's getting a phone call.
All right. Okay. So this is where we start talking about the different types of funding. So first, we want to talk about bootstrapping, which is self-funding. The definition of bootstrapping is using your own cash before you borrow somebody else's. Bootstrapping is great if A, you have the capital to put into it, B, you have the time to spend on it, and it can be really good for somebody who's never started a business before because you're going to make mistakes. Even some of the most seasoned entrepreneurs I know still make a lot of mistakes. And in this scenario, you're only losing your own money. So you don't have to worry about losing your house or losing somebody else's money, and then maybe you get your kneecaps broken or something.
Don't partner with the mafia, is what Rob said.
I think I told you I originally had a loan shark set up to do an interview, and it fell through at the last minute. I'm still so mad about it. So bootstrapping helps you stay safe, and it helps you learn the guide rails before you take on more risk. Now, the downfall to
Yeah, but it can
bootstrapping,
be super stressful, right? Because if your business isn't performing the way that you want it to, money's just going out and not coming in. So it can take its toll.
and I did that with Stretch Lab. I was putting my own funds into it for a long time, and it was never coming back. And I depleted my savings account, maxed out my credit cards, and finally I just had to sell it. So
This
it
is
does
one of those
happen.
things too where it's really smart when you start to work a business that you start building your credit beforehand, because banks don't like to lend to businesses that are under 2 years old. And so it can be hard to get access to a new EIN versus if you have some history built up, then you don't necessarily have to bootstrap. You have other options available.
Yep. Well, I'll give you some time to specifically talk about what that means and how you help with that. The problem with bootstrapping is it can take a very long time. And I know a lot of entrepreneurs that never get past first base because they tried to bootstrap everything. So it becomes a financial question. We'll get more into that later on. Then you can take out personal loans. So, like I said, we were talking about Richard Bronson, and when he first started in his garage, he took out a small personal loan to help him buy inventory and packing materials and stuff like that. So, a personal loan would be like a home equity line of credit, a credit card. There's unsecured credit lines. Once again, I'm not saying this is the best way to go, but it is an option if you can repay it. The other thing I'll say is banks get real sketchy if you're using personal loans to fund business deals. So sometimes you have to kind of figure out how to work the system. If you take out a HELOC for a business loan in Texas, especially, they're going to be really upset. The rules are a little bit more relaxed in Oklahoma, and they don't ask as many questions, but just keep that in mind. The next one was brought up to me by my publishing group, and I thought it was hilarious, so I had to put it in. But it's reaching out to friends, families, and fools. So this is people that you know personally that will put money into your business. And this is where we were just talking about partnerships can be a whole nother beast in itself. So anytime you borrow money from friends, family, I mean, what's the saying? Don't ever do business with family because it can ruin the relationship, right? It's usually faster, it's usually more flexible, but there's an emotional attachment that can be a real detriment in your mental health. If it's great when it works, but it's horrible when it doesn't. And unfortunately, too many businesses try to run before they crawl, and they fail, and they lose their family's money or friends' money, and just things go south. But the real goal with self-funding is to start small, prove your concept, and earn leverage. So, like in the case of Richard Bronson, he started small. He proved that the record industry was something that he can compete in. And then once it grew big enough, he used the cash flow from the record company to eventually start the Virgin Empire. All right. So debt. Debt is going to a bank or an SBA lender or something, some sort of family. And I do separate those because there are family-run offices that only do SBA loans and stuff like that. So typically your SBA loans are going to come through a bank, but they don't have to. Long story short of that. But this is where you can borrow to build. And it's not necessarily the best long-term play. If you're a very practical business, you're something that has been a proven concept for a long time. You're doing, especially manufacturing or franchises. Banks really like franchises because they're proven models. Banks do not like risk. So if it's a new concept, they are not the place to go. But bank loans are the lowest cost, but they're also the highest the highest amount of scrutiny that you're going to go through. They're going to go through every single document. You're going to have to pull a typical bank loan is going to take, if you're a new entrepreneur, especially with a new relationship to the bank, just plan for about 6 months worth of just getting the documents that they want. And here's the biggest catch with banking. A lot of people don't understand that if the bank's still asking for documents, they haven't even started the underwriting process yet. So I've worked on deals in banking. I've closed deals in 20 days. I've closed deals in 2 years. And it's, if you have a good pitch deck down, if you have all of your banking information organized and ready to go, you can really mitigate, you can really offset a lot of that time. But even once you get a term sheet and they start underwriting the deal, SBA is a minimum of 20 days. And that's if it's a very, very clean deal. More than likely, it's going to take 6 months after the term sheet. So it takes a very long time, but it is relatively safe. I'll also say in Texas, we did not like calling loans. We called one loan the entire time I was there, and it was because a husband and wife lied about their divorce. They took out the loan application in the middle of their divorce and still said that they were married. Once they were divorced, neither one of them were a strong enough candidate to support the debt. And so that is the only loan that we called. Oklahoma is a completely different ballgame. I swear they took out deals just so they can call the loans. My point is, bank loans are technically safer. And usually if it fails, the bank is going to work with you to figure out a payback. I know one of Clayton's favorite jokes is if you take out less than 20 million, then the bank is not necessarily a player on your team if it fails, right? If it's over 20 million, now you have a lot of leverage towards the bank and they're going to do everything they can to help bring the funds
Absolutely.
in. So that's why it's very important to understand the brand of the bank and make sure that it is in line with you, with your business. There's a difference between term loans and lines of credit. I think for this group, we probably need to go into that. So a term loan would be a lump sum of cash with the same payment over and over again for the term of the loan, right? So if you take out, I can't do the math quick enough for this, but if you took out $1 million loan, you would have let's call it a $10,000 payment each month. I don't know if that maths out, but use that as an example. Versus a line of credit, which is more like a credit card. So if you have $1 million line of credit, you may only take out 20, 30,000 of it. And then once you pay it back, then you can take out more. And so the amount that you pay is lower, number one. Number two, it changes from month to month as you make payments and pull more out. So it's a variable payment. Debt should really just be used as a tool. And the calculation that I always look at is, okay, if I take on the debt, is it going to actually improve my business? So are you buying equipment? Are you buying, maybe you need to expand your staff or something like that. Don't go take out a debt just to keep the doors open. There's better paths for that. There's other things you can do. But if you're just taking on more debt to keep the doors open, then you've got a serious issue and you need to do some more work in the business before you take on. You guys have anything to add on debt?
I think be strategic with it. I mean, truly, I've worked with a couple clients that just took it on because similar, like shiny object was like, oh, we can start this. And it's like, we don't have our feet under us to do that. But they'd already done it without even, I'm there to consult them. They just made the decision over a weekend and went and got, the personal loan or whatever on a Monday morning. And we were meeting Monday afternoon. And it's like, oh, okay, great. Now what are we doing with that?
Yeah.
And so
I think
it's
too,
like,
when people get the fast money, it's like a merchant cash advance and they just get murdered in in rates when it's quick. And it can really, you had to be really careful about that because it could put you out of business real quick.
Yeah.
The other thing too, with lines of credit, typically the regional banks will have less scrutiny for approvals. And so you may have a higher chance of getting approvals or at least stacking multiple lines of credit with pretty decent interest rates as opposed to a business credit card.
And I think Melissa, you're going to talk about this, but when you self-fund things where you may have you access your capital, whether it be savings or some other opportunities, I think people have, particularly startups, I think, that they really have to be careful about that as well, because they want to try to self-fund everything. But as Rob talked earlier, you can literally, if you don't have a plan, destroy your whole life. If you take your savings or a spouse doesn't agree with that situation. So it's more than just institutional debt. Sometimes I think it's your own equity. Sometimes you have to be very careful about.
Mm-hmm. And Melissa is here because she offers a lot of programs that don't require personal guarantees. So there's a lot of things that'll go into institutional debt. They're going to require that you have life insurance. So you need to make sure that you factor that into your pro forma. So if you take out $1 million debt, they're going to make you have at least $1 million in life insurance. So if you die, they still get paid back. They're also going to look at collateral. So whatever assets you have, they are going to make you sign a waiver that says, if this fails, we're coming to take your house. And then the last thing is a personal guarantee. And the personal guarantee basically is issuing collateral where they're saying you're guaranteeing that you're paying it back. And if you don't pay it back, then they can seize all of your assets, both for the business and your personal.
Yeah. I know a lot of, in consulting, like on product-based businesses where they're looking at distribution and just like a dealer selling through other venues. There was personal guarantees in those contracts, and almost every time they got crossed out. It's like, we want you to know. Like, we realize like it's in the contract so that you feel like you can redline something, right? It was there for a reason. But it was like, no, we're not joking. We want to get paid. You do this by the rules of the contract, and everything's good.
Personal guarantees can get you in a lot of hot water. I do want to acknowledge, I hear a lot of people that are so afraid of bank debt. And I remember there was a guy that I walked into a sports shop, a local sports shop. And the guy said, "What do you do?" And I told him I help prepare business models and then find banking for them. He's like, "That's the dumbest thing I've ever heard. You should never take out a loan." Yeah, but it also took him 40 years to be somewhat feasible of a business. Yes, it's scary, and it does need to have a lot of thought and consideration before you take out a loan, but it can also be extremely beneficial to your business. I was talking to a guy the other day, and he said, I still got a little bit of debt on this business. I said, that's actually good, because as an analyst or somebody in finance is looking at your balance sheet and you have no debt, then they're going to assume you don't really know how to manage money because you're not utilizing it in the best way.
Yeah.
So having debt on your balance sheet is actually a good thing if you're trying to sell or trying to get loans or something like that. So don't be so afraid of it you don't consider it, but you do need to be cautious with it. It's just like a credit card.
If you have a plan, it's good debt. If you have no plan and you're just trying to stay afloat, that's bad debt.
Yep, exactly. It's just like credit cards when you're 18, the
bad idea.
Yeah. I mean, if you use it wisely, then it's good to build up your credit. If you're going out and buying stupid stuff with it, then it gets you in a lot of trouble really quick. Same concept. All right, so equity. This is probably one that not a lot of our group is going to have experience with, but it's something that I've been utilizing a lot more recently because the banks have been so stingy with. So there's a couple different equity plays. There are angel investors, which most of us call this stupid money. These are people who, the majority of them that I talk to have been very successful in their own fields. For some reason, I keep running into these oil and gas guys that made a ton of money in oil and gas early on, and now they just want to help businesses, so they give people money. They are probably the least sophisticated of them. And I say that a little bit with a grain of salt because sometimes you run into angel investors who are very sophisticated. But more often than not, these are going to fall into the fools category of friends, families, and fools, where they have a lot of money, they want to do good with it, and so they just give it to people they like. Typically, when these people look at your pitch deck, they are analyzing the person that's pitching it more than they are the pitch deck. And they are more likely to invest in somebody they truly believe in rather than a business venture that they really believe in. Preston Porter is a perfect example of this. Melissa introduced me to Preston. Great guy, 27 years old, brilliant. I make him record our conversations because I can't keep up with him. But I took on a project for him. I'm not an angel investor. I put no money into it, but I put a lot of sweat equity into it just because at the time, I didn't really believe that project was going to take off, but I knew he was going to be somebody that I wanted to be in his circle long term. Turns out it actually is going to work. And it's going to be a really good play for all of us, so I'm glad I did. But a lot of angel investors are like that, where they would rather invest in the person than whatever they're pitching. Venture capitalists are like angel investors, but they're institutional. Most of the time they have, I can't speak for all of them, but all of the ones that I've worked with have kind of a funneling process to get funding. And a lot of them start with an incubator type program where you go through step by step of their model. And then at the end of it, there's funds available. Not all of the businesses they invest in have to go through that, but I would say 90% of them do. It's also a really good resource. Some of them will pay you to be there. Some of them you have to pay into it. It just depends on the venture capitalist group that you're working with. The Verge in Oklahoma City is funded by a venture capitalist firm. It's funded by Cortado Ventures. And they have a phenomenal incubator program that I believe it's free. I need to double check on that, but they will put you through something very similar to what we've created here. Actually, I've talked to them about using my curriculum for their incubator, but it's kind of the same thing where they sit down with you and they walk you through a pitch deck and how to put it together and a business plan. And then they introduce you to, if they're not going to fund it personally, then they'll introduce it to you, introduce investors to you. But to Melissa's point, there are venture capitalist firms that are very specific on what they will invest in. And like I said, funding's getting really hard to come by. And so I think their focus is becoming a lot more narrow, where before they would take on a lot of different industries, and now they're only focusing on industries that they know forward and back. Syndication is a really interesting one. The difference between a venture capitalist firm and the syndication deal is where a venture capitalist firm is an institutionalized investor. That's what they do long term. That's their business model. A syndication pool is usually a group of investors that come together and they pool their money together so they can fund projects. This is very common in real estate. I know multifamily seems to be the one that they mainly focus on in this, but they may have 10 different investors that come in, pool their money together so they can buy a very large multifamily. I'm actually working on a deal that's going to be like syndication. I can't talk about it in great detail yet, mainly because it may or may not happen at this point, but stay tuned. I might have a good insight on that later on.
You and your NDAs together. You always bait us, then you won't tell us.
I know. Subscribe to my podcast
Yeah.
that I don't have yet, but I will someday.
Right. You will, Rob. You will, Rob. We're gonna make sure you do. So.
Well, just like you made sure that I did this, and I appreciate
Oh,
that.
wow.
So
A
I've been
pleasure.
putting this off for months. All right. The biggest problem with the equity path is you're giving up equity, which means you're giving up ownership in your business, which means you have another partner in your business. We've already talked about some of the pros and cons of having a partner. Everybody wants their say, so you're just adding another chef to the kitchen. And if they don't fully understand or on board with your brand, or they don't believe in something that you believe in, then you can really come into a lot of conflict. I think the most common thing I see is a lot of entrepreneurs start businesses because they want to help people, where investors start coming in and they're only interested in making another buck. So you got to be real careful about who you give equity to. And sometimes this can be smart money. So think a Shark Tank where you have, Mr. Wonderful and who's the lady from CVS? I can't think of her name.
Laurie
You
Grenier.
have the FUBU.
Laurie Grenier. Yeah.
Yeah. And a lot of those deals get done. They may say, Mark Cuban has the most experience in tech, so we're a tech company. We want to partner with him. That's what smart money means. There's a lot of times where you can align yourself with venture capitalist firms or angel investors that have experience in the industry that you're going into, and they can really put you ahead of the game by offering not just money, but also advice and experience. Melissa, you've worked with a handful of these groups. Do you have anything to add?
Well, you talked about The Verge. Generator is another big one. It's Jenner
Yep,
and then
I've
the
worked with
number
them too.
8. I do believe you have to pay for those. But
I2E is another one.
Yeah, I agree with everything you're saying. That's the biggest thing is you have to decide whether you want to take on the risk for the debt or if you want to give up equity of the company, which is going to be the greater loss or plus.
Specialized pass. And Melissa, I'm actually going to hand it over to you because I know you've only got like 15 minutes. So if you want to talk about, to put you on the spot here, let's talk about your programs and how you can help raise funds.
Okay, so this is something I talk about for an hour, so I'm going to try to squeeze it into 5 minutes. But the really short version of this is that majority of business owners, when they start a business, when they have an LLC, an S Corp, or a C Corp, they're doing that. They're creating those so they have a separation between their personal and their business. But I'd also say that a majority of business owners don't realize that as soon as they put their name in that company, they guarantee anything, they sign their name on any kind of paperwork in that business outside of that business bank account, they are now 100% liable for anything that happens in there. So if their name is on that lease, if their name is on a loan, if their name is on a business credit card, if your name is in it, you're still commingled, even though it's for the business, if you're backed by it, right? So a lot of the work that we do is going to be more to try to help create an extra layer of protection for that business owner. If that means adding in some holding companies, some extra layers between the percentage of ownership. That could mean building corporate credit on the EIN of the company, which is something that most business advisors recommend that business owners do later. I think that's absolutely terrible advice. It should be done at the beginning because the first step of that is going to be going through making sure that the business is set out foundationally correct, which hits all the things that are normally going to go through the compliance department, whether if you're going through credit or if you're going through the bank, and helps prevent some of those red flags that LexisNexis, which is a data company that tells the banks whether you're a legit business or not, is going to prevent some of those red flags so that you don't get denied for silly things. So it could be that. It could also be making sure that you're registered correctly with the business credit bureaus and capturing all the expenses that are happening in the business. Now, when I say credit, that doesn't mean you go out and spend a bunch of money on stuff you don't need. That means things that you're going to spend money on the business anyway, capturing it on credit that actually reports to the business credit bureaus, which there's only 5% of accounts out there that actually do that, so that you have a positive payment history. The reason you want to do that, especially for an early business, is you have some of these regional banks that do loans and lines of credit based on SBSS scoring systems, which is going to take a blend between your personal FICO score and your business PAYDEX score, which is going to be your credit score through Dun & Bradstreet. So if that's not something that you've built, it's going to affect the amount of capital that you may have access to, especially for newer businesses. Typically, they want to see that your business is at least 2 to 5 years old, so there's some history there. So we use shelf companies to leverage some of that for newer companies to give them some age so that they get approvals for loans. We help them build their credit so that they don't have to personally guarantee everything in their business. We do something called shelf, we call it data furnishing, which I won't go too far into detail about that because of time. There's some sneaky Pete's out there that do this. So anybody that does it for you, just really want to make sure that they're doing it in federally compliant ways, or you could be stuck with a whole bunch of extra fees that you don't want to have. I saw that you also have grants in there. There's several different grant writing AI-based platforms that are starting to come out now. And there's one that I recommend to a lot of business owners called Quilify. It handles about 90% of the grant writing process. So that cuts down your time from 100 to 400 hours of writing down to maybe 20 to 40. So highly recommend that. It also helps with keeping ahead on knowing what grants are actually out there so that you have the time to write them and apply for them instead of finding out about them after the time has passed. So those are some of the things that we've offered. I don't know if you want me to dive into any of that further. You let me know.
Oh, do you guys have any questions before I jump back in?
Me?
No, I'm curious where like infinite banking would fall into equity.
So infinite banking could fall into like where Rob was just mentioning, some banks want you to have life insurance. You could just buy a term life insurance, or you could do life insurance that's whole life, or through like an IUL or a VUL. The benefit of doing that is that you have capital that's growing in the cash value portion of the policy. And depending on who writes the policy for the business owner, if we write it in ways where we're turning down the insurance, but we're cranking up the cash value, now you have the insurance to get the loan. You have the insurance for your buy-sell agreement if you have a partnership or something like that. But you also have a cash value component where you have capital that's growing at an uninterrupted compounded interest rate, which I could go into that, but I won't. But you can use that to leverage for lending against yourself. And if you have multiple of those can be put inside either your own trust, or it can be put inside a business trust where you're creating your own banking system and you're copying some of the same ways that banks make money, but for yourself, where you're recapturing that interest payments, which can give you better rates. Typically, it's going to be prime rates on the loans that you're taking. But because of the way that the interest is growing and because of dividends coming in, you're able to recapture that interest, which helps with opportunity costs.
Melissa, Rob and I and Mindy we're really big on storytelling. I know you're kind of pressed for time, but you talked about the story about the contractor that went with the FEMA projects and went down to Florida and got down there. You want to go over that story really quickly? Because I think it really resonated with me about someone not being properly funded.
So this kind of goes back to what Rob was talking about, where people have a fear of taking on any kind of debt, whether that's credit or loans or anything like that. Cash only can actually hurt your ability to get capital sometimes, but it also makes it hard, especially for businesses who are in trades. So for example, there's a client that I have that initially he was cash only. He didn't want to take out bank loans. He didn't want to build his credit, didn't want to have anything to do with credit cards, which I understand because they can hurt you if you don't use them correctly. But what happened was, because he hadn't done that, he had no credit history. He had nothing on the side other than what's on his kitchen table. So he goes down to Florida for hurricane relief. And he's going down there to help clear trees. So he takes his entire crew, they rent their trucks, they have lodging, they have food, they're down there for an extended period of time. But you also have to remember that this is a natural disaster, which means that you're dealing with insurance. And so he's not getting paid on these deals for a good 90, 120 days. In that time period, he's used up all the money that's on his kitchen table and had to let go of all of his employees and almost went completely out of business because he had nothing else to fall back on. So having a line of credit through the bank or different lines of credit, like say American Express Corporate is a no PG line of credit. It's a tier 4 account, takes a minute to get there. You have something that you can fall back on while you're waiting for these accounts receivable to come through, where you don't end up having to fire all of your employees because you used up all of your money.
Thanks, Melissa.
That brings up a very good point of something that I need to add to the enemy mistakes line is get funding before you need it. Because if you're trying to get funding when you need it, it's very, very difficult. To your point, like if you go to a bank and you say, hey, I've screwed up and I need money now, they're going, well, are these people that I should invest in or not?
Yeah.
So if you're waiting until something bad happens.
What happens a lot of times too is because a lot of people bootstrap, they're using business credit cards, which are personally guaranteed, so their name's on it, which means that their utilization is usually very high. And so by the time they actually go to get a loan, if their credit score is below 680, or if they've used over 30% of the credit that's available to them, well, now they can't get a loan. And they're stuck with very high interest rates unless they're doing credit through the bank where it might be prime rates. If you're dealing with, say, American Express Business, Capital One Spark, Wells Fargo, some of those guys, they don't report to the business credit bureaus for one, but they're also going to charge you personal credit interest rates. So you're talking 28, 29% interest. It can be a really big hole to dig out of.
Yep. I've had way too many clients that have done similar stuff to that, have waited until the very last minute to try to get funding, and then they've done something that prevents them from getting funding. So
yeah, I mean, we talked about the terms in the finance and accounting video and session where it's like, do you know like how your billing affects, when people are paying you and when money's actually coming back in, which speaks highly to Melissa's comment when he's waiting 90, 120 days to get paid.
That did make me think. I wanted to explain the way a commercial loan works because I don't think a lot of people understand this process. And I touched on it, but I didn't go into it. So I know that there's a lot of bankers and loan people that are in our groups, right? And they're all friendly. They're all our friends and they're good people. The problem is they have to then report to somebody else. So they may be really good people to have in your groups, but they can't necessarily guarantee that you're going to get lending because they then have to report it to everybody else. So the loan officer will go out and they'll find the business. And their job is to collect all the data, all of your financial statements, all of your business plans, all of your personal bank account information, and then they take it to somebody like me, who's the credit analyst. And then I spread all the information and I put it into a nice, neat little package. And then that package will go to either a credit risk officer or, even worse, a committee. So it depends. It changes from bank to bank on what the limits are, but it'll depend on the authority that each person has. So like for the bank that I worked at in Dallas, my CRO that I worked with had authority up to 10 million. If it went over 10 million, then we had to go to committee. The bank I worked for in Oklahoma, if it was over $1 million, then it had to go to the committees. Are at least the committee that I worked with, the bank in Dallas, we were a Spanish-owned bank, and the committee sat in Spain, and they didn't necessarily always understand American business. So there was a lot of time where we were having to, we had to deal with the MBA, and they didn't understand basketball is huge in Spain, but we had to first explain what the NBA was, why it was a qualified person or entity. I mean, the NBA is not a person, and then we could go into why we wanted to do the loan. So it was this whole long process, and it was just a cultural clash, right? The bank I worked with in Oklahoma had like 14 fucking people on this committee, and most of them were old retired bankers or CPAs. And it was so awful that the bank I worked for, they would actually try to structure their deals where they were doing like $900,000 increments to the loans. So if they had we had a builder that needed like $5 million to do a construction project, and they paid it out to him in like five separate $100,000 loans because they didn't want to go to committee.
Yeah. Death by committee. I mean, there's a reason that is
it's miserable.
Yeah.
It's these old retired guys that all they're there to do is just to poke holes and show how important they are. So it's an awful process. And so my point is, like, it takes a very long time to get through some of these barriers. So start it before you need it.
Yeah. So you went backwards on your slides.
I did. Melissa brought that up, and I meant to say that. All right. So to get back on, so we talked about Melissa's stuff, infinite banking, the personal. There's a name for the product where you mitigate the personal guarantees.
So our product that's proprietary to us is Tryturing, so TRYTURING. But there's also Fundability and Credit Suite, and they're all kind of similar. They're software that's created for the business owner to get them through the process from making sure you're set up foundationally correct, setting up with the bureaus, and working through that credit to get to no PGs.
And I know when I wrote this chapter, I had EIN lending in there because we've done this lecture before. So it just didn't translate to the slides. So I need to fix that. All right. So then we want to talk about crowdfunding, which crowdfunding is very similar to syndication. Crowdfunding is when you launch your product and then you bring on smaller investors. What was a platform that everybody used to use? Not Alibaba. GoFundMe.
Kickstarter or something?
Kickstarter. That's the one I was looking for.
Yeah.
Kickstarter, the big problem with it was they would have to post all of their patents and business plans and everything like that. Well, then the Chinese started ripping them off and just producing the products before the American companies could catch up.
I think that's why more crowdfunding is moving to the blockchain.
Oh, that's interesting.
Yeah, because it's more private.
That's good. It needed to happen because it's a good product. I mean, it's good for what it is, you know. So crowdfunding gives you a good chance to kind of test the market. So you can put it out there and see if investors are even interested. You'll get a lot of good feedback. And it's a really good way to raise money. I know a lot of them, they will say, we need, X amount of money. We need $1 million to get going. And then they will start selling products at a discount so they can catch up to it. So I know one of the Kickstarters I looked at was for, I don't even remember what it was for, but some product. And I could go in and, say the product retailed, I think it was one of the autonomous lawnmowers, actually. But I could go in, I could buy the rights to an autonomous lawnmower like a year before it came out at a very discounted rate. And then there were all sorts of other incentives included with it. They would offer free installation or something.
So
like
what's the obligation to the person that borrows from a kick? I mean, what commitment do they have back to the people lending them the money?
That's a good question. I'm not sure I know.
Do you know?
I'm not sure I've ever read through this contract.
Yeah,
I need to go look that up.
Yeah, because like I said, I mean, obviously, how about angel investors, Rob? You know a little more about angel investors. Same.
Angel investors. So it's going to be, there's going to be a lot of legal involved, and the contracts can change. So I can't say there's one standardized thing, but typically, and this is with a smart angel investor, like I said, sometimes so they just throw money around. Typically, they're going to, if they've done it right, they would have some sort of structured payments. A bank will do this as well. So let me explain the banking side because I know more about it. But if I took out $1 million loan for a bank, and they would have structured payouts on that instead of just giving me a lump sum $1 million. They will say, okay, go get your building plans and then send them to us. And once we have your building plans, then we'll give you that amount of money. So I would assume most angel investors would structure their deals in a very similar way, where it's like, okay, I will commit to $1 million, but I will pay out this much on these milestones, and it just mitigates their risks. Venture capitalists, sometimes I've heard of them asking for personal guarantees. Not always. A lot of them, or some of them, will have that written, like that's their differentiating factors. They don't have a personal guarantee. So with the crowdfunding, yeah, I really don't know. My guess is it goes into like an escrow account, and then once your thing's produced or as you need it, then you can pull on it. I imagine you don't just get a lump sum.
There must
but
be
I
some
don't know
equity stake in it. I mean, in terms of percentage of sales, or maybe what.
Well, you can structure the Kickstarter. I've seen several different Kickstarter crowdfunding deals where you can do an equity play. It doesn't have to. I'm talking about one that just happened to be a product, but you could do crowdfunding for commercial real estate where they do own, like they're buying in pieces of the equity. So it just depends on how it's structured. The good thing with banking is it's highly scrutinized from a government regulation standpoint. So especially consumer lending is very much by the book, very boilerplate. Commercial lending has specific steps that almost all of them follow, but it's such a much more complex transaction that there has to be leeway. So it would probably come down to how the deal is structured, what the legal says, and then how the payouts happen. So it can vary is the short answer to that. Asset-based lending, I know Melissa mentioned factoring at one point. So asset-based lending is something that a lot of construction workers use. Or no, Mindy, you talked about it. Basically, you're lending against your receivables. So in Melissa's example, she said it was going to take 90 to 120 days to get paid back on a lot of the stuff they were doing. There are institutions that will lend against the receivables. So you can go to them and say, okay, these are the receivables I have. I have 120 days to collect on it, but I need the money now. And so they'll give you the money now. And it's like a payday loan, now that I think about it. They will give you the money now, and then you'll pay it off when you get paid on those receivables.
Yeah.
This gets people into trouble, just like a payday loan, actually. I had so many construction clients that utilize this, and it once again, it's beneficial if you utilize it correctly with a good, reputable company. But something inevitably happens where somebody doesn't pay or take you to court and litigate against the amount that they owe you or something, and then you're in hot water because you've already told somebody else that you were going to pay it off. Melissa, you brought up factoring. Did you have an example of how that worked?
Factoring, and then you have data furnishing, which I kind of missed some of what you said because I was on a phone call, but I saw on your slide where it says when the banks say no, go specialized. That's where that kind of comes into play. So it could be based on factoring, could be based on future sales. Like if you're in construction, you expect a big job to be coming in kind of thing. Or with data furnishing is really ideal if you have a shelf company or if you're at least 2 years old. And what
I don't know
happens
what
with
data
that
furnishing is.
is so basically if you have a bank that has, say, a loan or line of credit that's in the rears, and the banks decided, you know what, we're better off just taking a loss on this. They take the remainder of that loan in combination with all the data and the receipts attached to it, and they bundle it and they sell it on the commodities market, which is usually where a collection agency will buy that. Data furnishers can buy that too for pennies on the dollar. So let's say if that loan was originally for 150, maybe there's 20 left, maybe we go and we buy it for 7. And what they do is they take that data and they backdate it on the business credit bureaus, which Dun & Bradstreet, Experian Business, and Equifax Business. They backdate it by 2 to 5 years, depending on how much you're needing. And what that's doing is it's showing a demonstrated ability to borrow and pay on the business credit bureaus. It's showing the banks that you've taken on X amount of dollars in the past. And they do what they call an SBSS scoring system, which blends your personal FICO and your business PAYDEX score. And usually this happens through more of the regional banks. They're still going to look at the personal because they want to know that you're a good steward of your finances, but it's going to be a loan that's heavier on the business. And so let's say if you bought data for $250,000, now on the credit bureaus, it's showing that you've borrowed and paid $250,000. Another competitor or another bank has lent this person money in the past, and so they are more likely to say yes. It may not be one loan for $250. It's probably going to be like multiple lines of credit through multiple banks. But that's one way that you could get capital. But again, if you do that, it has to be somebody who knows how to make sure that that's compliant so you don't get in trouble.
Yeah, we worked with a lot of construction companies that used fracturing, and the
It's
biggest
usually going to
problem
happen
is,
with manufacturing. Anybody who has a lot of upfront costs to buy the supplies to do the job.
yep, we would run into it because construction companies would take out deals with government agencies like ODOT or something, and they would have to go buy machinery to finish out the contract. So they would go buy the bulldozers and the cement trucks and whatever. And then government entities are notorious for slow paying stuff. And in that time, the construction company is accruing interest, and then they get upside down because government entities are slow paying.
And weather factors in. I mean, for construction specific, weather's such a huge factor
Yeah.
that, they might actually start having penalties put on them.
Yeah, that's what I was going to say about New England. Mindy, that weather is such a, like, for example, in like we do construction 365 days a year here in Oklahoma. In Maine, basically, they shut down in December because they can't pave the roads. So they literally lay everybody off, and they have to go draw unemployment because then the construction. So basically, 9 months out of the year. But if a company's not financed during that time, obviously they're not paying their employees, and the kicker there is you're going to find employees willing to do that, right? I mean, that's the big thing. People are willing to collect unemployment during that time. But seasonality does play a role in a lot of these decisions. And Rob talked about that before.
All right. Grants. Grants are, they can be set up several different ways. A lot of them are set up from nonprofit organizations or government entities that have money to spend. For example, one of the ones that we're working on now is through the Department of Energy, and they have a certain allocated amount of cash that they can spend on entities that would improve their business, right? So they are paying that out as a grant. Other ones can be privately owned. We've done a lot with private owned grants. And the process to get a grant, if you ask grant writers, is very different than getting a loan. If you ask me, they're the exact same. You just have to change a couple steps. Melissa, you were talking about grants. You mentioned remind me the name of the company. I was going to write it down. Qualify. So there's databases where the grants get posted. Grants.gov, Qualified can, from what you've said, can go through the different databases where they're posted and give you more access to it. They are sometimes very complicated to get through. I remember I was applying for a grant. This is when I was a professor. And I spent 2 hours going through the process. And at the very end of it, it was like everything that I was trying to do fit until the very last slide of this 2 hour presentation. They're like, oh, yeah, this is only for marinas. I'm like, why didn't you say that at the beginning? So it's so damn frustrating sometimes. But they usually don't have to be repaid, so it's kind of free capital. They're usually set up with, like I said, nonprofits, and they're trying to support entities that would help them achieve their mission. Have you written one lately, Melissa?
No, I haven't written one lately. There's more AI companies kind of coming out that scrape for what type of grants are available, and you kind of put in what kind of industry you're in, and it'll populate what kind of grants are available and if that kind of fits within what you're doing to save you time, like to your point, Rob, without having to go through the whole thing to find out 100 hours later that I don't qualify.
Right.
It's a very low approval profile as well. But anybody who, if it's minority-owned businesses, tribally owned businesses, anybody in healthcare, businesses with a cause, it's much more likely that you might be able to get some of those grants, provided that you know what's available and that it takes a long time to write those, and they're very detailed as far as what they're looking for.
They're very detailed. Also, there's a lot of them that we've applied for that we just never heard anything back. We don't know if it got rejected. We don't even know if it got submitted. So it's really frustrating. The main difference between applying for a loan and applying for a grant, both of them require pitch decks. And a grant company probably won't be able to tell you that. The biggest difference is when you apply for a grant, you need to go pull the entire write-up of everything. Like I said, it's a lot of information usually. Use AI to pull out the common words that they use, and then use AI to update your business plan to use the exact same language that they do. Because, like I said, it's usually mission-driven, and they want to make sure that whatever you're doing is on mission with them. So you need to use the exact same language. Don't assume that the people reading the grants are going to understand how your company or your nonprofit or whatever fits in line with theirs. You have to make sure that it's very clear. You have to really you have to do a good job of stating your case of how your product or project fits in with their grant requirements. There's also SBIRs, which I'd put under grants. They're usually government contracts that typically for the Department of Defense. But if you get on there, there's a lot of weird stuff that I guess falls under Department of Defense, like agriculture is always on there, stuff like that. So you just have to go read through them. And grants are easy to get free help with. I know Tom Wavering used to be at OU. He was great at helping people with SBIR funds. There's a handful of other resources to help you with that. And then there's really good grant writers. All right, let's wrap this up. So, long story short, when banks say no, using some of these specialized paths are very good options. You don't typically have to give away equity, but there's, of course, downfalls. Grants take a long time. You may never even hear back, and you have to change your business plan to fit theirs. Asset-based lending, we talked a long time about how it can get you in a lot of hot water really quick. And crowdfunding, there's a lot less risk with it, but you never know if it's going to work out or not. So, and the more creative you can get, beats your credentials in a lot of these lanes. So the more, like I said, if you're writing a grant, you need to make sure that it spells out exactly how you fit that mission. The more creative you can get with how that works together, the better off you are. All right, so that's covers all. Not every time I talk to Melissa or somebody else in these groups, I find new paths to it. But I think I researched like 16 different types of funding, and I boiled it down to these main types. Like there's different subsets and categories of a lot of these. There's all sorts of different banking programs that you can look at, but realistically, they're all either fall into the term loan or line of credit categories, right? But there's all sorts of different programs. Different banks have different programs specific to them. There are programs specifically for certain industries, certain investments, and things like that. So there's no way that I could capture all of them, but those are the basic categories.
Well, Rob, we really appreciate it. I mean, I think what you've done in your book, and I think everyone I've talked to inside our group and the guests that we've had has added real value. And I think as we help you move this forward, and looking forward to your podcasting and bringing guests on. And Melissa, thank you for. We know we've missed you at the meetings, but we know you've been learning more stuff. And when you learn more stuff, you bring it to Rob, and he brings it to us. Thank you for being here, and Mindy. Thank you as well for facilitating. And everybody will be having a next meeting next week, and by then you probably won't get this video till after that. So we're not live.
Yep. Pretty sure Mindy feels like she's herding cats, trying to keep me and Clayton in line.
Yeah,
so,
I just called her mom. I just texted her back and said, "Yes, Mom."
There's no telling where this would have gone off the rails if it was just me and Clayton putting this together. So thank you, Mindy.
Amen.
Well, thank you, guys.
All right, so to wrap this up.
Go ahead, wrap it up, Rob.
The long and short of this is nobody's coming to save your deal. I talked to too many business owners that are daydreamers, and at the end of the day, they can't put pen to paper and make things happen. Yes, this gives you a boost, hopefully helps you understand what the right funding path is for you and helps you put together the business model. But at the end of the day, you have to do the work to get it done. And once you have the funds, you have to make it happen, because people will come after you to get their money. And hopefully you don't get your kneecaps broken. Hopefully you're not doing it with Guido. But sometimes things happen. Make sure that you really, like Clayton said, we love the story. It really does make a difference. I don't think a lot of people reading grants or credit analysts or loan officers can tell you that the story makes such a difference, but it does. But the story only gets you in the room. You have to make sure that your pro formas are buttoned up and tight, and make sure that everything is easily traceable, and understand how the banks and credit analysts and the people reviewing it can understand how you reach your numbers. Pick funding that protects your control and compounds your confidence. There is nothing worse than sitting there going, I have no idea how I'm going to pay my next mortgage payment or my next loan payment. So, bad things do happen. There's a reason. Wait, what's this statistic? Like 90% of businesses fail or something. There's a reason for that, because it's hard. And like I said, I know very seasoned, very smart entrepreneurs that have made bad investments. So it happens. So make sure that you protect yourself and never gamble more than you can lose. And let's get your deal funded. Let's get it done. Don't let the deal fund you. One of my favorite books, and I don't tell many people this because it's weird. Fight Club is one of my favorite books because it's so twisted, and there's a lot of different aspects of it. But one of the concepts in there If you actually read the book, it's more about fighting capitalism than it is about guys actually fighting each other. But that's besides.
Well, I watched the movie. It took me a while. I was probably 2/3 of it. I still couldn't figure it out.
The book's better than the
Yeah.
movie, and I love the movie.
Yeah.
So, but either way, there's a line in there that says, "Whatever you own ends up owning you." And with business, that is something that everybody should remember. If you're not taking control of your funds, if you're not taking control of your business, then it's going to end up controlling you. And that's when people lose families, they lose their minds, all sorts of stuff. So keep it all into perspective.
Yeah, sometimes the emotional Guido is worse than the physical. The stress that you go through and everything. If you ever use that in one of your podcasts, emotional Guido, Clayton gave it to you.
I like that one. I'm going to steal that one.
Anything else, guys? Any comments, questions? All right.
I don't think so.
Have a great evening. Thank you very much.
All right.
Bye-bye.
Thanks, guys.
Bye, guys.
House.